I run the quality of earnings team at Treewalk Consulting, which is a mid-sized CPA firm. Last year, we kind of worked on across sell side and buy side 50 or 55 different transactions. So we see, and that was just in 2025. So over the last 3 years, it's probably well north of 100. Across North America, we've done some globally in UK and Australia, but very North American heavy. Probably 75% of our deals are across the US, 20-ish in Canada, and then 5% ad hoc across other countries. We don't really specialize in one particular industry. We have a kind of a range of various different businesses that we've seen, from anywhere from as small as 200K in SDE up to 11.5 million in EBITDA. So it's a bit of a range. I would say our most of our deals fall in that SMB and SBA loan compliant transactions. So I would say on any given typical deal, the deal size is probably like $3 to $5 million, and then north and south of that, it's just depending on the business that folks are looking at and the type of deal they're looking at. So we sort of see it all across the industries, and over the years we've gathered a lot of interest data, a lot of things that we see that's happening in the lower mid market, and why it's different than the mid market and why it's different than large cap companies. And really for us, we tend to be focused on small businesses, small to medium SMB businesses, and that's really what our quality of earnings looks like, and that's great. And so I'm going to kind of go through a few slides on what financial due diligence is, where we slotted what the point of the quality of earnings is, why do businesses get it done, why do sell-side businesses get it done, why you need it as a buyer, and really what it should tell you and what you should gain from completing a QOV review. After which, I also want to show you guys what a QOV looks like from a PDF perspective, as well as we're going to go into a little bit nuances on, I'm sure you guys can see QOVs and things like that, but really, what have we seen in the market, right? Having done 50 transactions last year, we've got some interesting data on why deals have died, which deals that we've gone in and post QOV have seen, like this deal is not a great deal. And then also how many deals percentages wise dive, how many go through, where the retrades happen, and what you guys should look at as red flags, sort of always pre-LOI, and red flags you should monitor post-LOI. So kind of without further ado, I'm going to get into what financial due diligence is. So when you guys think of financial due diligence, is really in a post-LOI process. Operational diligence, sometimes you guys might outsource that, but a lot of times this is what searchers are doing themselves. Legal and financial, you tend to outsource. Commercial, that depends on the type of business you're buying. And I think someone mentioned insurance, for example. If you're an insurance business, some of this stuff you're probably going to want to outsource as well. So when we think of financial due diligence, we're the first person to go post LOI once you guys have signed. And really our goal is to verify the EBITDA or STE that the seller and the broker have told you, and to ensure that you're buying a business that you think you're buying, right? There's so many times, and we'll get into some pitfalls and we see later. I would say probably 30% of our deals, that EBITDA and STE, maybe even larger, like 35% of the deals that we work on, EBITDA and STE comes in quite a bit lower. Another 15 to 20, it comes in a little bit lower. And the other 30 to 40%, it tends to be fine. So really, when you look at those metrics, you're almost every deal you get under LOI, you can imagine about half of them are going to have a lower STE or EBITDA number, or they're going to have an inaccurate net working capital number. And then the other half tend to be okay, or at least within a reasonable threshold. So when we think of financial due diligence, it's really a sprint. We get signed up post LOI, and we're going in there and we are really digging into the entire financial acumen of the company. And really, from a QOV perspective, the reason why lower mid-market QOVs and SMB QOVs are different than mid-market is we do more than just financial due diligence. When I was so my background was, I was at Deloitte, which is a big four accounting firm. When we did financial due diligence at the big four level and mid-market level, really the financial reports we're getting from sellers, and we were getting from the sellers accounting team. The sellers accounting teams have like 15, 20 people. They've got VP of finance, CFO, directors. So it's reasonably okay. So we're not worried about, okay, is this financial information real? So we're doing a lot of other things. When you're an SMB, a lot of the times the seller's accountant and tax accountant is their bookkeeper. A lot of times the seller is the bookkeeper. A lot of times the seller's wife is the bookkeeper. And so the financial statements are not done up to GAAP standards. And that's when it becomes a problem, because you're basing your valuation off GAAP standards. And so really, from a financial due diligence perspective, we care about financial reporting oversight significantly. Proof of cash, that's a reconciliation. We always start with adjusted EBITDA, net working cap. These are all the procedures we do. And then really we put this together and we try to tell you guys as buyers a story. Okay, what does this mean? What does it mean that the proof of cash variance is 2.5%? What does it mean your adjusted EBITDA is dropped through 10 due diligence adjustments? What do you mean your net working capital peg is PTM and not T6M and it's a 1.5 million? Like, what does that mean to you guys as a buyer? And that's our goal as a quality of earnings provider, is to really get in there and like help you guys across the process. And really, a lot of the times when we do these transactions and deals, especially in lower mid-market, especially in SMB, I'm going to emphasize that because the lens you need to look at SMB business is way different than a lens you need to look at a mid-market business. SMB, you need to look at your end customers. You need to look at who their customers are. You need to look at what are your macroeconomic risks, what are your customers' macroeconomic risks. Any small swing in the macroeconomic environment or in your customer's environment has a pretty large impact on your business. As large businesses can get away with losing a customer, a lot of times SMB businesses can't. And so really, you have to make sure that you guys are buying a business that has sustainable earnings into the future. So as much as we care about past earnings when we do a QV, that's not really important to us. The reason we look at past earnings is to verify future earnings. So really, like, you can tell me your TTM EBITDA was 5 million, great. But I don't really care if your TTM EBITDA is 5 million if I think your next 12 months is going to be significantly worse, right? And so I think that becomes a substantial difference when we do a QV. And the end goal is really, that's what we're trying to do. And so why does it differ than a financial audit? I always like to show this slide because people tend to get the two confused as to what an audit is and what a quality of earnings is. They are not the same thing. An audit is there to verify information. Quality of earnings is there to verify and then take it another step further, put analysis on the information, help you understand the information. It sort of ends up being a consulting engagement, right? Because an audit is fact. It's a matter of fact. Did this revenue occur? Yes or no. Is this a customer? Yes or no. Quality of earnings, fact, and then color and context. So it becomes an extra layer of added information. Is this a customer? Yes, but it might not be a customer in the next 6 months, or their margins are decreasing or compressing on this SKU that they keep ordering, or they are a customer, but we might lose them because our sales rep has switched. And so I'll give you guys a real life example right now. We're dealing with a situation where we are working on a sell side QV. The business does $5.7 million in EBITDA. Amazing business. They are on the verge of losing one of their largest customers, we just found out. But why is that? Because the sales rep at that customer, so it's a large aerospace manufacturing business, and so they sell a lot of parts they get a lot of businesses from Boeing, really, right? And their sales rep at Boeing is recently retired. Okay, now what happens? That's $2.5 million in EBITDA that's up in the air as we're going to close. All the revenue exists. They earned all this money from Boeing, but now they've got some qualitative factor that might impact future earnings, where you lose a sales rep. You know, I know a seller flew down to Boeing to meet the new sales rep that was allocated to him, trying to make sure that there's no hiccup in the work that they're going to get, blah, blah, blah. But really, like, there's going to be a hiccup, right? And that's something where the numbers don't tell you that, right? The QV looks fine. 5.7 EBITDA, great. It is 5.7 EBITDA. But there's qualitative factors happening in the background that could be affecting this in the future. And so really, as we're on the sell side for that, right? So as a sell side QV provider, we have to kind of know that. But imagine being on the buy side of our transaction now. If I was on the buy side QV, I'd be telling my buyer, like, hey guys, we should make an adjustment for potentially losing this client, because if you guys lose this customer, we are screwed. So we got to tie it into seller note. We got to tie it into earnout. And so really, stuff like that happens in deals that makes the quality of earnings numbers change a little bit, because there's real life tangible adjustments that happen that are on the fly and that are qualitative. And so when you think of a quality of earnings engagement, that's why we do one, right? Is to prevent situations like this. On the buy side, is to ensure that, hey, we are asking about this. We're asking about the relationship with sales. So we're looking at what salesperson drives the most revenue, because that's going to be impactful to our EBITDA. So there's twofold. It's you're looking at, yes, is the accounting and adherence with GAAP, is revenue recognition correct? Is accrual-based accounting correct? All that's correct, great. And then the second step is looking at it from a qualitative and sort of a higher lens viewpoint. So I want to show you guys, I'm going to walk through a little bit of what a QV looks like, what a report looks like. And then from here, we're going to talk a little bit about common pitfalls we see, areas we see that are incorrect, and really lift the veil a little bit on what happens behind the scenes and how we go about it. And so this is sort of what a QV end product looks like, as you guys can expect from a P4. We have our definitions, exec summary as we move down. I'm going to skip this stuff because a lot of this stuff is very detailed and tailored to the company we're looking at. We look at their recommendations for improvements, how we can fix their accounting function, what you guys as a buyer should be doing moving forward. And I'm going to look at the quality of earnings so you guys can see what an actual quality of earnings looks like. And so this business, for example, you can see there's 18 adjustments. So it's a significant amount of adjustments happening in this business. And some of them are for different reasons, and there's a lot of things that are coming up when we look at this business, but a lot of them are normalization activities. Like bad debt's a big one, right? A lot of SMB businesses, they don't write off bad debt. So right away, a lot of times you'll get these businesses that have massive accounts receivable, but you realize, hey, this one's been overdue for 5 years and the customer hasn't paid. And so really, every time you guys look at a deal, you guys should anticipate some bad debt or bad debt reserve. Now, every industry is going to be different. Every market's going to be different. But if you guys don't see bad debt on the profit and loss and you see a high AR aging, I would immediately have a yellow flag for that to say, hey, we should have some sort of reserve for having some bad debt. Deferred revenue. This is one of the most misunderstood concepts in accounting, and I think 75% of small businesses get deferred revenue wrong. Deferred revenue is when you take cash up front for services yet to be rendered. So conceptually makes sense. The problem is a lot of small businesses do their books on a cash basis. So when you're doing cash-based accounting, let's say I promised you, Andy, I'm gonna, cut your lawn tomorrow for $200. Okay, Andy gives me $200 today. I haven't earned that money. So in small businesses, they would take that 200 and book it as revenue. It's not revenue. Legally, it's not revenue. From US GAAP, it's not revenue because I haven't done anything. I've just taken money. And so it's basically a deposit. And so what happens is deferred revenue, for depending on the type of business you're in, it could be a substantial amount. I've seen a deal, it was a med spa business out in the Midwest. And so what they do is they have subscription models where you pay up front for 3 years of services or 1 year of services, or 50 visits, whatever the number is. They had, they were claiming like 2.5 million in EBITDA. They had 1.6 million in deferred revenue, right? So you can imagine, like, that's not EBITDA. That's just deposits you've taken from people and you haven't done anything. So imagine me as a buyer. What if I buy that business? All of a sudden, I'll have all of these people on 3-year subscriptions that I have to service for the next 3 years, and I'm making $0 because the seller walked away with all the cash these buyers had paid for. So really, you want to make sure every time you have deferred revenue or any kind of prepayments or deposits, you discuss it up front. There's usually 3 ways you can deal with deferred revenue, and depending on the business and the deal and how good you are at negotiating, it's going to change your deal structure, and dollar for dollar, it's going to impact you quite a bit. So I would say when you have a deferred revenue component, get a QV, get somebody on your side who's going to find out basically the best way for you guys to allocate deferred revenue and the most advantageous way for you as a buyer to maximize your basically dollar for dollar value in deferred revenue. So that's where deferred revenue comes in. And as you guys can see, there's other normalizations. We see rent and insurance are very, very common ones, and they're very typical for businesses to be understating the rent and insurance, especially if you were if you're not in the industry, you don't want to have experience, your insurance is likely going to be higher than the seller's insurance has been historically. Also, keep in mind, if you guys are, depending on the state you're buying in, if you guys have worker comp claims, your premiums might be going up. There's a lot of things that can happen that can drive that up. So always be mindful of that. Now, when we do quality of earnings, a lot of the times the seller gives us add backs. backs too. We call those management adjusted earnings. So another large part of our QV is to go in and ensure management adjusted EBITDA is correct. And there's actually going to be an emphasis, placed on going through fine combing every single dollar that the management says is an add back. I always tell people this: every business claims they have add backs. There's only a handful of add backs that are valid and accurate. And an add back has to be something that's like really an add back, right? Like sometimes you get people who add back advertising, marketing, and I'm like, guys, like, just because you think we're not gonna have to spend on advertising and marketing on the buy side, like once we buy, we're probably gonna have to increase that. If anything, it's a negative add back, right? Like payroll is a big one, right? People try to add back payroll, but it's like, okay, when we buy the business, very likely your salaries are going to go up, your rent's going to go up, insurance is going to go up. And so all of these things that are material need to be fleshed out through quality of earnings. And it's really an important part of what we're trying to do here on our end. And so I'm not going to dive into each of these adjustments one by one because it'd take forever, but there's just know that, for example, this one is 18. I could pull up any other QV we have, and sometimes we get up to 20. Sometimes we get up to like 15. So it really just depends on the business and how good their accounting has been and how much work they've done to really emphasize their accounting function. And so every time we do a QV, I tell people, I always want to get the seller on the phone and I always want to get their accountant on the phone. Together, separately, it doesn't matter. You cannot do a QV if you don't get the seller and you don't get the accountants on the phone. So anytime you guys are hiring a QV provider, if you guys are hiring one, make sure they're taking these management calls, make sure they're going on the phone, make sure they're talking to the seller, make sure they're talking to the seller's bookkeeper, because those conversations are going to yield a lot of information, whether negative or positive, is going to come out of those actual calls. And so from a quality of earnings perspective, that's called adjusted EBITDA. Is the number we're trying to figure out is what does this business really make, right? And we'll get into some common pitfalls in a second here. I just want to go through this QE for the next 10 minutes, and then we'll talk about some real deal killers we've seen in 2025 and where we're seeing multiples in the industry going. And so the second biggest section you'll see in quality of earnings is going to be the net working capital. Now, net working capital can mean very different things depending on the time frame used, depending on the period used, and depending on the accountant you ask, unfortunately. Net working capital and working capital, by its definition, is current assets minus current liabilities. So anytime you're working with a non-M&A CPA, they're going to tell you to just take current assets and minus current liabilities. Okay, that's definitionally what working capital means, but it's not an accurate definition of what mergers and acquisitions working capital means. And so I'll give you guys an example of this. We were doing a transaction last year, and the seller had talked to their tax accountant to give them a working capital calculation. The tax accountant came back and said, hey, you actually don't have any working capital need. Your working capital is negative. So when they say that, they're trying to say like, okay, there should be no money left in the business because you don't need it. You have no working capital. Great. I look at the calculation, and what the seller's tax accountant had done is the seller had a line of credit for $3.5 million. A line of credit, by definition, is a liability. So by the seller's tax accountant's definition, that was reducing working capital. Now, when you look at working capital from a mergers and acquisitions and transactions point of view, any line or credit or net debt-like items needs to be backed out of working capital. The working capital need of the business was actually $3.5 million. The tax accountant had zero because he included the line of credit. And definitionally, we were $3.5 million off. So you can imagine, to the seller's surprise, like he was like, that's a lot of money, $3.5 million we're talking about. And so really, depending on who you ask and who you're getting to do your working capital calculation, that's a dollar for dollar. That buyer, like, I think they agreed, they didn't end up agreeing on the full 3.5, even though I think it should have been. I think they agreed on like 1.8 million left in working capital. But like right away, the buyer walked away with an extra $1.8 million in that transaction by getting a QV, because we were able to identify an error in the net working capital calculation by the seller CPA, because by definition, he included debt-like items, which was a line of credit in this case. And so that's an example where we do net working capital. It's like, okay, what is it? It's definitionally could be different, and it could be different depending on who you ask. Now, another key thing to look at, you see we've got averages, and we see we have T12M, and you see all the numbers are different. Which number do you use? on average, you use trailing 12 months, but there's a caveat to that. If my business is growing, my net working capital need is higher. So anytime, and this is where if I'm on the buy side, I'm going to advise my clients differently. If I'm on the sell side, I'm going to advise my clients a little differently. Since this is a buy side group, I would tell you what I would do for you guys, or what you guys should do if you guys, end up going through with the transaction is you look at, is the business growing? If the business is growing, you want to use a trailing 3-month net working capital peg, because inherently, when your business is growing, your working capital need is increasing, especially if you have inventory, especially if you have high accounts receivable. If your business is shrinking, you want to take a larger time frame. So you walk away with more working capital, and you can argue to your sellers like, hey, I think taking an average of 3 years is better because A, B, and C. Now, the opposite is true for a seller. If they have a growing business, they're not going to want to give you trailing 3 months working capital. They're going to argue trailing 12. And so this is where negotiation happens a little bit on the working capital peg, and where it's a little bit misunderstood is like, what's the real number? Well, that really depends on who you ask and how you do it. I would say a trailing 12 is usually a reasonable compromise regardless of the situation, unless the business is like significantly growing or significantly declining, or there's a case to be made to use another metric. So trailing 12 is usually the average we would use in this case. Now, when we have inventory and when we have other accounts in this, it gets a little bit convoluted. We have prepaid expenses. We have accrued PTO and accrued liabilities the seller, we have to fulfill post-close. And so a lot of those get missed. So really you need to find somebody or find some team who knows what they're doing for the net working capital calculation, because it could have a large impact on your business and a large impact on your purchase price dollar for dollar. So usually what happens once you do this net working capital calculation is, let's say in this case, the net working capital peg is 1.45 million. That means you as a buyer should receive $1.45 million the day of close. Now, how hard is it to get that number exact on the day of close? It's really hard. So what happens is 90 days post-close, we do what's called a working capital true-up, where we go through the books and we go through and we make sure what you received was actually 1.45 million. Any shortfall, the seller owes you dollar for dollar, and anything surplus, you owe the seller dollar for dollar, so that both of you walk away with exactly what was written in the contract, and you walk away exactly with, in this case, 1.45 million. And so when you're doing net working capital, you want to make sure you have enough cash flow. And really another reason we do net working capital, and as an SMB owner, is cash flow is tight, right? Cash flow might not be tight for the seller because they're built a legacy business. They probably don't have debt on the business. They probably don't have investors. You guys as buyers are way different. If you're taking SBA debt, you're paying interest at 10.5% or 9.5%, whatever it is today. You might have investors. Your cash flow situation is very different than a seller's cash flow situation. And so really, you need to be paying attention to working capital probably 10 times more than the seller was historically. Now, I'll give you guys another example. We did a deal where accounts receivable was ballooning month over month over month. And really the seller's response was, well, it doesn't really matter. Like I'll just go ahead and collect this whenever I want, right? And I was like to the buyer, listen, if you do that, you're going to go bankrupt in the first 3 months unless you have a $400,000 line of credit. And so that's an example where cash flow is going to be so important to you guys as buyers. And really, as you service debt, it's going to be, it's way more pronounced and profound than it was for the seller. And so really getting a good understanding of what your net working capital peg is, what your cash flow cycles look like, is extremely important as you guys go post-close and as you guys look to buy businesses, because every business has different working capital needs. And I always tell buyers this: whatever the working capital is today, if the seller tells you it's less, I promise you post-close, it's going to end up at the same number it is today. So if you, in this case, if you buy this business with $1 million in working capital and I tell you it's 1.45, be prepared to have 450K of your profit sitting in net working capital for perpetuity until you sell. You're never going to see that money. It's gonna just be sitting in your inventory and AR, and it's going to be cycling through over and over again. And so really, if you guys don't negotiate this well, it's going to have a meaningful impact on your business, and it can really be a detriment, I guess, in a lot of cases. So this is a really important part of the QOV. And as we go downwards, you can see that cash conversion cycles and how we convert the working capital. It's one thing I told you guys at the start to give you a number. It's the second thing to tell you what it means from a cash conversion cycle and what it means from a cash flow perspective. So that's always going to be different. Now, once we do those procedures, we walk away, we start getting into the meat of the income statement and balance sheet. We start looking at gross margins, like how is that impactful? Where are the gross margins going up, down? Why are they going up and down? Is there tariff compression? Is there compression from manufacturers, distributors? Is there compression from buyers who are not willing to pay higher prices? And so really looking at gross margin by product, by SKU, by company is extremely important as we start to look at how much money the business actually makes. Salary and wages. If you guys are buying manufacturing businesses, what's the labor cost in that? So there's a lot of things that get nuanced as we get down into the income statement. As you guys can see, there's top revenue sources. You can see where their money is coming from, how they're making it. Has that changed? Has their buckets changed, right? Who are their top customers, and are they moving? Are they changing? What's their churn rate been per customer? And so we did a QOV recently where we looked at a business where for 3 years they had no churn, which was great. But then all of a sudden I said, hey, listen, they had no churn, but they've got no new customers. And so that's a little bit worrying as well, right? And so, it's looking at churn and new customers coming into the business is always going to be a good mix. And really, as you guys look at a QOV, that's going to be the secondary stage of a QOV, is really figuring out how this impacts your P&L, and if you're comfortable with some of the stuff that we're seeing in here. So, you can see that as we go through the QOV, there's a lot more that is done at the appendix level, summary recommendations, proof of cash, which is the reconciliations to ensure the cash statements are right and things like that. So that's what a QOV looks like. I want to show you guys now tangibly a real life scenario of a carve out QOV we did, just so you guys can see what the actual work looks like behind the scenes. I was like the Excel, you guys usually see the PDF, or you guys might not even see it depending on if you've seen a QOV before. But really, I want to show you guys like what impact a QOV can have. So this is a deal we did for a carve out last year. And the reason I like this business is, and why I wanted to present this to you guys, is they had a large deferred revenue component. And so you can see once we normalized their deferred revenue, they had a drop across all lines of income. You can see this is their reported EBITDA. And you can see we came in lower in almost every single year, and came in lower even once we added out some allocations. So if you're doing carve outs, they're a little bit trickier anyways, but this isn't why I wanted to show this one. The reason I wanted to show this one in particular was the deferred revenue component. So they had these contracts, and I've got rid of the names here, but you can see pre-adjustment what the revenue was associated with for all these customers, and post-adjustment. So you can see all of these numbers are moving and changing. And the reason for that is this was revenue that the seller had booked on a cash basis. This is revenue on an accrual basis. And so you can see like some of these customers have had large drops in revenue. Like this one, for example, all these numbers are different. And the reason for that is because of a cash versus accrual timing difference. This business had large contracts, and it was receiving money up front for these contracts. And I'll show you guys quickly here what I mean by that. So if you guys look at this projected revenue on a cash basis, great. This is when they would receive cash from customers. So I'll take this line item, line 24. They would receive $75,000 for a 12-month subscription in February, and they'd book $75,000 in revenue. So their February revenue is $112,000. That's obviously not right. So when you look at a cash flow perspective, we've taken that 75 and we've adjusted it month over month over month, and now it's normalized in actual periods earned. So anytime you see deferred revenue, you need to make sure you're doing this exercise to ensure that your revenue is recorded in the right period. Now, that's just step one. Step two is, as we start to look at what this means for debt, is deferred revenue is a debt-like item on the balance sheet. So not only was the buyer decreasing EBITDA because of this deferred revenue, the buyer should actually get 62,000 in cash left in the bank. This is not part of the net working capital. This is separate from net working capital. This is cash left in the bank. And then on top of that, you get your net working capital. So really the buyers, if had they not recognized deferred revenue, they'd be losing A on the EBITDA and B on the deferred revenue. So it's almost a double whammy when every time you have deferred revenue is you need to make sure you're getting it right, because this could really, it can have a significant impact on you guys as you guys move forward and close deals. So ensure that deferred revenue is always brought to the forefront, net working capital, and a few of these other things that we're going to look at. So that's just something I want to show you guys. This is also an example of what a QOV can look like from a data book perspective. So post, you get the PDF report, but this is kind of what a Excel looks like. So it could be a little bit different. You can see we looked at some contracts and things like that to ensure we were doing things accurately. So that's what a QOV looks like behind the stages. Now I wanted to touch a little bit on QOV and some real life examples. So the first thing I want to touch on is, why deals break, right? Because as you guys are always can be worried about finding a deal you love, you go under LOI and the deal dies. So in 2025, if I was telling you guys at the start, we probably did 50 transactions. I'd say about a third of those died. About a third. A third of those were fine, closed, no issues. And another third of those are probably going through a retrade or going through some sort of structure adjustments based off of AR QOV findings or declining EBITDA results. Of the 50 or 55 transactions we did last year, I would say 65% had a year-over-year decline in 2025 revenue compared to 24. So that's a significant amount. So there were some industries that did better than others, but I will say overall, we're seeing most businesses having a top line and bottom line decline, either post QOV or even pre QOV that the seller or buyer is aware of. There's 2 deals today that we're working on, and both of those deals came in with lower EBITDA numbers in 2025 compared to 24 and lower revenue numbers. And so that's what's happening across the market in terms of market trends and what we're seeing. So, there were some negotiations and those things were kind of fixed. And so now let's talk about stuff that, okay, post LOI, you find a business, it's great, you hire a QOV provider. Okay, what do we usually find that kills deals? And I've got a few war stories for you guys. So this was a e-commerce business that sold like smart bikes, basically, right? It was an international company. They had warehousing 3PLs across North America. They sold smart bikes, really kind of bike lights, I think they were. So what had happened in this case was the seller had a purchase order from a customer. What did the seller do? The seller decided that, hey, this customer submitted a purchase order for 6 months in the future. It was a small business. It had about 550K in EBITDA. He booked 125K in EBITDA, and he booked an accounts receivable in the same breath. So he credited revenue, debited accounts receivable 125,000 based off a purchase order. We're doing the QOV, and all of a sudden I say, hey, this AR you've got from this company, like, where's the invoice and why has it been sitting here for 3 months? He's like, oh, there's no invoice. We're going to get an order for them soon. So I booked it as accounts receivable and we booked the revenue. Okay, well, that's wrong, right? So they just recognize $125,000 in revenue that they don't even have based off of PO. That killed the deal on the spot, basically, right? We went back to the buyer. Buyer looked at it. Oh man, our EBITDA went from 550 to 400 and odd, 405, 420. It's not a great business. Can't really buy it at that dollar value. Bang, that deal's done. Dead in the water. This is a story of an invalid payroll add back we worked with last year. Business is doing about 3.5 in EBITDA. This was a $400,000 adjustment. Okay, what happened for this was the seller said he is adding back payroll expenses for his kids, his wife, his people that aren't really needed, and family members. Okay, cool. he's saying these are add backs, they're valid, they're legit, awesome. We agreed with him. We said, listen, this is your wife. You're saying she doesn't work. The seller buyers had been down there. They said, you confirmed, yep, wife doesn't work. She's getting paid for doing nothing. Great. Okay, added back 400,000. Here's the issue. We added the seller added back 400,000. At the end of the year, when the tax accountant does the taxes, he had already made an adjustment for this. So you see every payroll period, the wife's salary is coming out. So you see it in the P&L, you see it in the general ledger. Great. At year end, the tax accountant takes that number and adjusts it out into distributions. So he moves it to balance sheet distributions. So he accurately classes it. Well, okay, so you can't add it back because it's already been taken out of the P&L by the tax accountant. So really, he's trying to add it back twice. That was a $400,000 adjustment that we caught because of that, right? And the seller wasn't aware that the tax accountant was making that adjustment in the general ledger. So had we not gone in the general ledger and traced the payroll and really looked at it from a really granular lens, that was a $400,000 adjustment. Business was selling at 6x, I think, on that one. So you can imagine what the multiple, like how much the buyer would have overpaid had that not been caught. And so that's another war story. And this is something we saw. I think this happened 2 months ago. So it's not a long time ago. Another war story. Seller refused to leave working capital. So this happens more often than the other stories I'm telling you. This is more of a general trend. I've probably seen this on last year, 6 deals, the year before probably 10. Every single time you go under LOI or you look at a business, you should ask yourself, is there going to be working capital left in the business? And here is another example I want to show you guys of a business where, and I'm going to just pull up the sim when I get a chance, because this could save you a lot of money. Because this business, anytime you see a sim and you see a balance sheet, and I'll show you guys what I mean. This is a real sim for a real business that we worked on. Historical balance sheet. I could tell you in 2 seconds, this doesn't make any sense, right? Like, this is a sim. Like, why would you have a balance sheet that, so this is the P&L, right? You got 2 million in revenue, you got expenses, COGS, all these things. And you're telling me your total current assets are $0 and your liabilities are $0? That makes no sense. And so this is an example where the seller did not want to leave working capital. So what did the broker do? He made a sim with $0 in the balance sheet because the seller didn't want to leave working capital. And the buyer goes to me, great, Avnit, I've got this deal. Can you guys do the QV? There's no working capital need for this business. Look at the balance sheet. Great. No, there's a working capital need, right? I think for this business, the working capital need ended up being like $350,000, right? And the broker and the seller had presented $0. And so that's a massive difference, right? And that happens very often. That happens probably in 10 to 15% of the deals we see, maybe more, right? I don't have the stats on that, but seller refusing to leave working capital. And I'm telling you guys, if it might not sound like a big deal, but if you don't have the right amount of working capital, just tell yourself mentally that's how much extra you're paying for the business. If the business working capital need is $1 million and you're getting 0, are you comfortable paying an extra $1 million for this business? If the answer is yes, great, buy it, bring a line of credit so you don't go bankrupt. But if the answer is no, then really you need to have a different conversation, right? So always keep that in mind when you guys think of working capital. These are real dollars and real purchase price dollars. Deferred revenue as a debt-like item. That's the example we just talked about right now with deferred revenue and what I showed you guys. Same thing. This example was the med spa deal I was telling you guys about earlier, where the seller didn't want to leave the money because what the seller is going to say is, I earned that money. They're my customers. They gave me deposits. I'm taking it. Nope, they can't take it. Legally, they're not allowed to take it. They shouldn't be allowed to take it. So if you have deferred revenue and the seller's walking away with the money, they're walking away with your dollars, and you're going to not only lose out on that money, you still have to satisfy that customer. And so if the customer's not paying you because they paid the seller, and you have to sell them the product or service that the seller promised them. So you're getting hit twice on that. So keep that in mind. If you've worked for revenue and it's not coming, you're going to get hit twice. Construction and WIP. This is for anyone buying a construction business and you don't get a QV, I pray for you, because work in progress and percentage of completion. So under GAAP accounting, you can do this revenue recognition method called percentage of completion. Most of the time, a seller is going to try to increase their percentage of completion. They're going to try to increase their revenue, undermine their cost, and push costs out to a future period. So you need to make sure when you're doing your QV, you're looking at WIP schedules, you're not overstating percentage of completion, and you're looking at correct margin backlogs and revenue, and you're making sure there's no material EBITDA reduction because of those things. Because I will say WIP accounting and percentage of completion, 75% of small businesses get wrong because they just don't know how to do it, and they don't know how to accurately track their costs and the revenue for projects, and they don't understand when they're allowed to record revenue. Also, when you got construction businesses, you should have retainage. That's another thing. So, anytime you have construction businesses, your working capital situation need is a lot higher. You're going to have a lot more costs up front. Then the numbers completely change. And so every industry is a little bit nuanced, but construction is one of those where it's like you really need somebody to do a deep dive in. Otherwise, you're gonna, there's a good chance you get hit pretty hard with overstated EBITDA and understated net working capital needs. So we're at the 45 here, guys. I'm going to stop it here and open it up for anybody to, ask general questions, QB questions, deals they're working on, or just anything they want to talk about.
Go ahead, Julie.
Yes, hi. Thanks, Avnit. You're a great presenter. Totally
Thanks,
appreciate
Julie.
your conceptual overview. So my question is about timing. So if we go back to that category of deals that you said, kind of between 3 and 5 million, I think they fall under the SBA umbrella.
Yeah.
How long does a QOE typically take?
Yeah, I would say I average tell my clients it's 3 weeks, and I will say we've done some in 12 days, and we've done some that take 4.5 months. Now the variations are because of extreme cases, but I would say 3 weeks is on average for a typical business. Let's say everything's normal and everything's pretty standard. 3 weeks is enough time, and that includes the seller getting us the information, us meeting the seller back and forth, blah, blah, blah. Usually by 2.5 weeks or 2 weeks, we have a good idea as to where things are going. Like I can tell you, hey, Julie, I think you should hold off on legal right now because we might be finding some things. Or it's like, hey, I think most things are okay. If you want to start getting legal going, you can while we finish this up.
Okay, incredibly helpful. Thank you.
Of course.
Quick question here. What should a buyer budget for a QV?
Yeah, so I think it depends, again, obviously industry size and things like that, but typically for most of you guys, a QV Lite, which is the data book I just showed you, is probably the best deliverable instead of getting the PDF report. I could talk about that a little bit more in depth later, but most of our buyers, they get the Excel data book as a deliverable. I would say probably anywhere from 12 to 16K, somewhere in that range, up or down, depending on the type of business and things like that. But average is probably like 15, I would say, 14, 15.
And if you get into something that's more manufacturing or construction with heavy.
Yeah, so that's probably in the higher end of the range. If it's manufacturing construction, if you're dealing with W-2 versus 1099s, I'd say 15 is a good benchmark for something like that. Simpler businesses might be like 12, 13. Manufacturing things might be like 15, 16, somewhere in that range.
Thank you.
Yeah. Quinn.
Yep. Yeah, question for you. I've been chatting with a seller that is firmly in the not including any working capital camp. Unfortunately, due to, I think, a set of missed expectations set with his original broker that he's hanging on to now with his current broker. The current one is trying to get him to understand that there is a need to incorporate working capital. But I was curious if you could expound upon strategies or negotiation tactics, etc., to get a seller to understand that working capital is like the gas in the gas tank driving the car home, and not, you'd be pretty pissed off too if you bought a car and it didn't have any gas in there. So
Yeah,
if you
totally.
share anything on that, that'd be great.
Yeah, I think that happens a fortunate number of times. Where I found success, I think in the past, is visually just sharing my screen, and really like what I did for you guys today is where I say, okay, here I pull it up on my screen, I say, listen, and I walk them through line by line. Like for example, I would go, okay, here, let's say, I'd go, okay, here's the net working capital. The tabs are hidden, but I would, make the calculations, because I think a lot of times sellers, they tend to just say numbers like, oh, I think it's like 150, very round numbers, but really just working through what the working capital is, how the numbers are calculated, how you arrived at that conclusion, and what it looks like post close, and really emphasize like, hey, listen, like after I buy this business, I'm not going to see this money either, right? And really just emphasize that it's money trapped in the business almost into perpetuity. But I think visually showing it and actually doing the calculations and having like a trailing 12, trailing 36-month lens where you can present to the seller tends to work a little bit better, in my opinion, at least. Yeah.
And I'm curious, you had mentioned just in some of the studies you did that 2024 versus 2025, you tend to see the revenue go down, but there were some industries you said didn't follow that same pattern, or rather some types of businesses. No. I was curious if you could share a little more on that.
Yeah, absolutely. So I think, yeah, most industries, I think we've seen decreases. One industry that's stayed steady, and I've actually we did 5 QVs in this space. It was aerospace MROs and distribution centers. And so basically aerospace maintenance repair shops have been very strong in the last year. And this is coming from 3 different aerospace MROs across the country in different regions. We've seen all of their EBITDAs jump up. And so that was one industry off the top of my head that's been doing really well. Yeah, so like that seems to be one of the hottest ones. I have to go back and look at some of the stats as to see some of the others, but I'm happy to shoot you a note after with a couple of the other industries, and you got it probably somewhere in here.
That'd be awesome. Thank you.
Yeah.
I wouldn't mind receiving the same note if you'd be so kind. Thank you.
Yeah, absolutely. Yeah, maybe I can, if you guys want to, Andy, I don't know if they've got my contact information. If you guys want to just reach out to me via email, and I could just send you guys a follow-up.
Let me send your email here in the chat as well.
Yeah, of course. Yeah, and then just shoot me a note, and I'll go back and get some other industries and things like that I'm seeing.
Then I'll also include your number, Avnit.
Sure, of course, okay? Yeah, that's fine.
All right, there you go, guys. I sent Avnit's contact details in the chat. Feel free to reach out to him. I've included his number as well.
Perfect. Thank you, Andy. Yeah, feel free to reach out to me, everyone, and I'm happy to kind of follow up with any information you guys need.
All right. Do you have any further questions, or maybe forever hold your peace while we have Avnit here? Take advantage of the time that we still have.
So I have one more. Is there ever a case where you need to go on site for the QOV?
There hasn't been. There was one instance this year where we were gonna do it because their systems were the only time we would need to is if it's a proprietary deal, or the seller cannot send us the information. It happened twice this year or last year, but both times the broker or somebody nearby was able to go and pull the reports for them. It's only if it's like the seller is like, I don't know how to send my QuickBooks reports to these guys, or it's somewhere on the computer and I don't know how to get it. But both those times it was a proprietary deal and the buyer just went on site and sent us the information. So it was wasn't a big deal.
Okay, thank you.
All right, well, we still have a couple of minutes left. I'll give back your time and I'll be posting the recording of this call and ClickUp. So if you would like to rewatch it, or if you do have any direct questions to Avnit, feel free to reach out to him. And just to also let you know, guys, Avnit will also be there on the next workshop. Oh, rather, will be presenting as well on the next workshop. So watch that out for those who will be part of the next workshop. And yeah, thank you so much, Avnit. We really appreciate your insights. It's very valuable to our AEs. So yep, thank
Yep.
you, and till next time.
Thanks, everybody.
Thank
Thank
you.
you.
Thanks, everyone.